The global decline in oil prices puts Egypt in a complex puzzle. We'll be exploring how the government is handling the situation in our special series on the effects of falling oil prices across Africa. Hello there, welcome to this edition of Global Business Africa from the Kenyan capital, Nairobi. Oil is one of the key things we'll be looking at in the course of this program, but it's not the only one. Here's what else is in the pipeline. South Africa's power utility Eskom has exhausted its reserve margins. We'll be in Johannesburg telling you why. And Tullow Oil writes off over $2 billion of spending on exploration in the wake of falling crude prices. Let's start tonight with the grim news from South Africa. The power outages are now going to be a lot more frequent and a lot worse. Eskom's Chief Executive Officer, Sidisho Matona, said that the possibility of load shedding every weekday over the next 3 months is now very high. He made those comments in a briefing earlier on Thursday, where he outlined the utility's financial status and ongoing talks between the government and Eskom about the company's funding gap. Now, part of the problem in this funding gap is attributable to overdue debts from power consumers.
At the moment, as we speak now, at the first week in January, the total debt is around 23 billion, but the overdue debt is 15 billion. The Munich debt is sitting at around 4.7 billion and Soweto debt is sitting around 8. On the Munich side, we follow a process where we have engaged with the Munichs in terms of payments. And you're well aware that we had started a process of disconnections in the Free State province, but we were asked by the ministers to not engage in any disconnection until they have a chance to involve themselves and try to find a political solution in terms of this. So we are still waiting for that. But Munich's, where we've got the biggest problem, is in the Free State, it's in the Limpopo province, and it's in Mpumalanga.
Right then, Angelo Coppola was at Eskom's briefing earlier today. He joins us now live from Johannesburg for an in-depth discussion on what went on over there. Angelo, did we get an update on Eskom's current cash position and the cash-raising measures that the company is taking at today's briefing?
The short answer is no. There have been lots of meetings that have been happening specifically between what Motana calls the technocrats in government, which in the Department of Energy and Public Enterprises, and Eskom management. Today, the Deputy President Cyril Ramaphosa was in the building. He had a meeting with everybody before the briefing started, but we have no clear picture about where they're going to get the funding from. Mr. Ramaphosa hasn't made any announcements yet either. So at the moment, we're in the dark in terms of where or how that money is going to be put together. As you heard just now, one of the major issues, of course, is that overdue debtors book and the political imperatives that are facing Eskom, which places them in a really tough and difficult position. Raman?
Indeed. Let's talk about the ugly word in the room, tariff hikes, tariff adjustments by the National Energy Regulator in South Africa. Are they an option to partially enhance Eskom's cash flow?
Raman, in fact, it's the only option that was discussed in any depth today, and it was put forward repeatedly. But on the other hand, the financial director in the room was saying that the utility will still use some of the guarantees that they're currently holding, but they're going to be using them sparingly. The CEO told us in the room that the tariff at the moment doesn't reflect the price of electricity. And this is something that the consumer in South Africa really doesn't want to hear. But he was quick to point out that it would be a gradual increase, if that makes it any better. But he also said that it's unlikely that NERSA, the regulator, would grant them the full increase that they say they need. Raman?
Indeed. In an interview with Business Day, this was published earlier on Wednesday, IDC's chief executive argued that the disposal of stakes that the firm holds in various listed companies in order to raise money for Eskom was, and I'm quoting him here, out of the picture. Now, if that's off the table, what other fundraising options does the government have?
Well, let's just take a step back here for a second, because he made that comment in a newspaper interview. It's not government policy yet, as far as I know. The IDC CEO might well have to eat those words. But look, Eskom's Matona did say that he doesn't know what the status is of the plans to sell those government stakes in those businesses. So at the moment, it appears that government has a couple of options. It could provide more guarantees, as they've done with the likes of SAA. There is, of course, the partial privatization option that they could follow, but there hasn't been much appetite for that option with Eskom just yet. Rahman?
Indeed, and we do know that would lead to quite a few ideological battles in government. Final question for you. Now that we know that load shedding will essentially be a regular feature for South African life for the next 2 years at the very least, how will that affect manufacturing and mining output?
Well, the bottom line is that in the mining sector, they're sitting in remote areas. Many of them are used to generating their own alternative sources of power and energy. So they have some form of backup on tap. The problem here is whether that alternative energy source can pick up the slack if there is continuous power outages during this load shedding that's going to be happening daily for weeks for the next 3 months. And has it been tested, and what's it going to add to the cost of the ounce or the gram of whatever's coming out of the ground? On the manufacturing side, I spoke to the owner of a label printing company, not a big one, a medium-sized one, and he said to me he simply can't afford the $100,000 price tag that a generator is going to cost him to ensure that he has this continuous power supply. And I believe that many medium-sized businesses in the country are probably in a similar position. Rahman?
Indeed, we'll have to leave it there for the time being. Thank you for that. That's Angelo Coppola live in Johannesburg. Now, despite the dismal performance of the wider South African economy, you will recall, of course, it shrunk by 0.6% in the first half of 2014. The Johannesburg Stock Exchange had a relatively decent performance overall in 2014. Angelo Coppola joins us once again. He's exploring what the first quarter of 2015 holds for South African capital markets.
South Africa's economy and the financial markets here are heavily dependent on their major trading partners' economies. It's still a case of when the US sneezes, the rest of the world gets a mild cold. For the emerging markets, however, they tend to get a longer-lasting bout of flu.
Market volatility in 2015 has really increased, and there are several drivers to that. We have continued to see a drop in the price of commodities, in particular oil, but copper yesterday also suffered a big decline. And that's reflective of what's happening in some of our major trading partners, such as China, the sluggish growth in Japan and in Europe. And of course now some concern that that might be slipping over to the United States.
Safe haven US Treasury yield has been plummeting. It's been similar to the 2008 crisis. The commodity prices have been coming down at a similar rate, certainly led by oil. We're now seeing copper doing the same thing. And we are seeing something like gold holding up.
While many are surprised by the drop in oil prices, its impact on the South African financial markets and the country's economy has been limited due to the relatively weak rand. But it is a sign of other potential problems.
You're seeing commodity prices fall like that. It is an indication that you're seeing a dry up of liquidity. And stock markets are showing this and currencies are showing this in emerging market currencies. Emerging market stock markets are also showing that drying up of liquidity. And so the effect of the ending of QE may well be that we need more.
Quantitative easing didn't seem to play a major role in the performance of the JSE last year, though. It set several records. 24 companies listed on the exchange, 8 of those in December alone. And the equity market recorded its best day ever in December, with value traded reaching some $5 billion.
Equity derivatives market peaked in June of the year in terms of value traded, but we also saw in October an all-time high in terms of the number of trades, where we had 395,000 plus trades in a single day. So a big surge in activity, mostly towards the third and fourth quarters of the year.
And while much is made of the level of inflows into the JSE, some of that money is hot money, as asset managers look for high interest rate environments and above inflation returns. And that's likely to continue.
But we did see a net inflow of foreign funds into our market in 2014. I think that's very important compared to a net outflow in 2013. And again, we've seen strong foreign interest in our derivatives market, which is quite pleasing for us.
There's no question that there's generally no correlation between what the stock exchanges in the country do and what happens in the economy. And this is also evident in South Africa. The current power crisis that's underway will have an impact eventually on what's happening in the stock market, because a lot of people investing in shares that actually need power to make a profit will probably start looking at alternative investment opportunities. I'm Angelo Coppola for CCTV at the JSE in Sandton.
Ethiopia and Italy have signed a 4-year trade agreement, focusing on bilateral trade, investment and cultural ties. Leslie Murungu has the details.
Ethiopia has had diplomatic relations with Italy since 1889, and the visit by Italian Foreign Affairs Minister Paolo Gentiloni is expected to further strengthen relations between the two countries.
One of the areas of our discussion was the trade and investment, and on trade and investment it's on the increase, and we still believe that there is a great potential for increased flow from Italy to Ethiopia and to boost trade and increase the trade volume. But the progress is really good.
Gentiloni hopes that his trip will lure more investors from the European nation to Ethiopia.
The fact is that Ethiopia is a so huge market with a so important number of citizens, and I think that the Italian business community can understand better these opportunities.
Currently, there are at least 90 Italian firms operating in Ethiopia and more than 100 investors, 71 of whom are at the pre-implementation stage, while 35 are already handling projects. Italian companies are largely involved in Ethiopian infrastructure alongside Chinese companies, especially in building mega hydroelectric dam projects such as the Grand Ethiopian Renaissance Dam and the Gilgel Gibe 3 Dam. Leslie Murungu, CCTV.
Quick run through equity markets here for you. A day of positive numbers right across the board, all the way from Nigeria, up about a quarter, the NSE 20 in Nairobi, and of course the JSE up by over 1% respectively. Of interest coming from Nigeria, however, Seplat Petroleum secured the option to get about $700 million for acquisitions. It is, of course, considering buying London-based Afrin PLC. Consolidation should be an interesting story to watch up in West Africa. Coming up next, Zimbabwe seems to be beating a retreat on its indigenization laws. We'll tell you how. And we'll be in Egypt next, looking at the government's reaction over there to the fall in global oil prices. It's a double-edged sword. We'll explain why shortly. Africa is on the move. It's home to 7 of the world's 10 fastest growing economies. We help you make sense of the fast-changing African business landscape. We take you where business is happening. Global Business, weekdays at this time on CCTV Africa.
Effects of the austerity measures are evident and were expected. Egyptians, however, seem to be patient about it. But El-Sisi told government he wants to control the prices promptly before people's patience runs out.
Welcome back to the program. You're still watching Global Business Africa from the Kenyan capital, Nairobi. Now, Zimbabwe's government has eased its stance on the implementation of its indigenization law in order to restore investor confidence and to lure in the foreign direct investments and the trade that it needs to kickstart the country's economy. In changes gazetted on Wednesday, foreign investors can now negotiate with individual ministries on when and how to achieve their indigenization targets. Farai Mokutuya has more.
The changes were first mooted by Finance Minister Patrick Chinamasa while presenting his 2015 national budget last year. And now it is law that foreign investors have the leeway to propose when they can meet the 51 to 49% threshold. Previously, they were required to meet it almost immediately. Authority to approve empowerment plans has also been devolved from the indigenization minister to individual line ministries who now oversee investments in their respective sub-sectors. So, for example, banks, which had been the cause of a bitter turf war between the finance and indigenization ministries, will now have approval directly from the finance minister. The indigenization law, in force since 2010, has been cited for dwindling foreign direct investment inflows into Zimbabwe, which have averaged about $400 million per annum, while other countries in the region have attracted nearly $2 billion per year. Government has said that it will not backtrack on that law despite calls to repeal it, and state media says that the 51 to 49% threshold will remain in force. Farai Mwakutuya, CCTV, Harare, Zimbabwe.
Let's talk about Tullow Oil. It's written off over $2 billion of spending on exploration and a number of its assets in the wake of the crash of global oil prices since June last year. The London-listed firm is under pressure to cut costs. It made the write-offs on exploration in French Guiana, Mauritania and Norway. It also cut planned capital expenditure for 2015 yet again to $200 million. Now, these are just the latest in a series of cutbacks by oil firms around the world as a direct result of the decline in Brent and WTI crude futures. BP, for example, will be cutting 200 staff jobs and 100 contractors in its operations in the North Sea. Shell has dropped plans to build one of the world's biggest petrochemical plants. Premier Oil is reducing its exploration spending this year by 40%. Tullow, however, does say that its 10 oil field in Ghana is well on track for mid-2016 startup. Right, then let's get some more details on Tullow's latest operational update. Kiri Blenkensop is live in London with more details on that. Kiri, despite the write-downs and the reduced capex, Tullow's CEO says that they're still reviewing the business to make it a lot more efficient. But what more can be cut at this point in time?
Well, we know the London-listed company has been really feeling the heat when it comes to cutting costs. And this is, of course, on the back of that spectacular dive in oil prices, Brent plummeting almost 60% since June last year. Now today, Tullow announced, as you mentioned, that it had written off $2.3 billion relating to exploration work and a number of its assets. Group investments for this year were also shaved by $200 million down to $1.9 billion. And the market certainly welcomed a cut in expenditure this year, with shares in the Africa-focused company initially rising almost 3.5% before settling back in the red. Now, while we didn't get any confirmation from Tullow's chief executive that the company will trim some of its 2,000-strong workforce, we do know that the company is still reviewing further reductions to operational expenses, which could mean job cuts. And CEO Adrian Heavey says Tullow is resettling for a low oil price environment, so the company is certainly feeling the pressure from those sliding oil prices.
Indeed. Let's focus on one particular aspect of its write-downs. Tullow is taking a $500 million hit on the sale of its operations in Uganda to Total and CNOOC. What went wrong in that deal?
Well, we simply don't know the details of this contract. Over the next 3 years, Uganda was planning to build an oil refinery and pipeline for crude production in 2018. The government had forecast Ugandan output at 200,000 barrels per day, and in the first quarter of this year, Uganda was also planning to hold a new round of exploration licensing. Now, it was expected that by the end of last year, all three, Tullow, Total and China's CNOOC, would have signed oil production licenses, but in November, only one of those companies had a license. So at this stage, the details surrounding those licenses still remains unclear, and whether or not it had any impact on that deal.
Indeed. Finally, Kiri, the company also does plan to be back in Guinea in the second half of the year for exploration on the offshore for Tullow well. What measures, if any, is the company taking to limit the risk of Ebola infection among its staff operating there?
Well, obviously, it's difficult for any company who's eyeing expansion in West Africa. The region is still crippled by this deadly disease, so it would be a very delicate operation if Tullow goes ahead with its plans. Now, the company would face less risk, somewhat less risk than others, with offshore operations seeing less exposure to the disease. Most companies operating in West Africa, whether it be oil or other sectors, have comprehensive medical screening procedures in place, as well as limiting its operations to essential staff only. So investors would be expecting something very similar from Tullow. Now, there is some good news coming out of West Africa. The World Health Organization says All three countries that were hardest hit by Ebola have recorded their lowest weekly number of new cases in months. Guinea in particular saw the lowest weekly total of confirmed cases since August 2014. So a glimmer of hope there for companies planning to return to the region.
Indeed, we'll have to leave it there for the time being. Kiri Blenkinsop there live in London. Now, still on oil matters, but from a completely different perspective on this one. The net effect of the global decline in oil prices in Egypt's economy and what Egyptians and their government will be paying for fuel is a complex puzzle. As a net importer of petroleum, in theory, Egypt is in a fairly good position to make significant savings. But as Adel Mahrouri reports on What's Hot Tonight, that's not necessarily what will happen.
After increasing petroleum prices in the summer, Egypt saved about 6 of its $17 billion annual subsidies expenses. If the current prices remain steady throughout the financial year, Egypt could save over $4 billion more. But citizens will not witness any change in petroleum product prices, and the government intends to keep this difference as a surplus in the budget.
The price drop is not that simple on Egypt. We export and at the same time import from our foreign partners. We have fixed contracts, so for us petroleum prices don't fluctuate like the global market, but in the extra shipments we buy with the international prices day by day. So for the regular citizen, he won't feel any differences in prices because the government partially subsides products by at least 1/3 of the price. Except octane 95, it has no subsidies, but it won't get cheaper.
There are numerous factors that could suck this surplus. The international prices of oil will decrease revenue from petroleum exports. The global effect on Egypt partners could reflect on the economy as well. Many expect Russia's economic stagnation would decrease the number of tourists coming to Egypt. They represent about 25% of Egypt's annual visitors. Gulf countries' aid to Egypt could also decrease. Already they started moving from pure financial support to investments, which is expected to freeze if the low oil prices last longer.
The aid from Gulf countries like Saudi Arabia, Kuwait and Bahrain depends on the surplus they have. Some fear that this bundle of financial support to Egypt could in one way or another be affected. But it seems that they are sending a message to comfort Egyptians that there should be no change in the aid.
The surplus in the budget should decrease the internal debt, and with Fitch increasing Egypt's credit ratings, Egypt will have more chances of getting foreign loans. Analysts expect the end result would be a maximum of $6 billion surplus in the budget. The decrease in Gulf aid and tourism revenues is also expected to be around $6 billion. But this will pressure the Egyptian pound price to the US dollar. So even if oil prices keep steady, it could become more expensive to Egypt. Adel Mahrouri, CCTV, Cairo.
Now, Egypt's main stock market index, the EGX30, ended 2014 over 30% higher than it started the year. Now, its headline numbers of this sort that have repeatedly reinforced the argument that Egypt is now recovering. It's stable, especially after the turbulence of the last 3 years. When I spoke earlier to Karim Sadek, Kala Holdings Managing Director in charge of logistics and infrastructure, however, he pointed out that on a fundamental basis, Egypt's capital markets and energy subsidies still need a lot of reform.
At the end of the day, that's a politically driven improvement on the capital markets, but the fundamentals of the challenges that the Egyptian economy faces remain there. Yeah? You have an overloaded government bureaucracy, you have skewed energy pricing, you have huge parastatals with running big debts, you have a budget deficit that was 10%, that planned to be 10%, will probably be better on the back of lower fuel prices, but you know that's an externality that's not necessarily continuing. So yeah, the last 6 months the stock market has been great, but I think this is mostly related on the back of political stability, not necessarily a perception that Egypt is past a difficult economic transition. I think it's just starting. You have to remember the biggest, most sensitive issue, which also do have implications in politics, is fuel subsidy. Yeah? And the government has moved fuel prices aggressively as a percentage point, but you're starting from such a low base price. So before the July 2014 increases, diesel price was 15 cents a liter. Yeah, it went up to 25.
Right then, let's move on to commodity prices here for you. Crude oil still lingering well under $50 a barrel. Of interest, however, is what's happening across Africa. Kenya cut the price caps for fuel down to just about $1 actually earlier this week on the 14th of January. Now Zambia is following suit, and Thursday it cut pump prices for petrol by 23%, for diesel by 28%. Those take effect from midnight on Friday. Up next, we dive into a little bit of history. We'll take you to the oldest market in Jordan's capital of Amman. What's kept it ticking all this time? Find out shortly. Right then, let's move on to a question of Jordan. The oldest market in the capital there, Amman, dates back to the early 1940s. It's one of the oldest marketplaces in the kingdom as a whole. Now, if you're going there to find the latest and greatest gadgets, don't bother. But it does attract shoppers and visitors with a fairly unique variety of goods, and its crowded and ancient, lovely alleys.
Amman's oldest market, Souk Bukharia, does not stock high-tech consumer items or the latest gadgets. But its more traditional offerings attract a loyal following and regular visitors from out of town. Mohammed Bukhari has been working here for 50 years. He says the market is well known for its wide range of goods and is a must-see sight for Amman's visitors.
It was established in 1942 in Amman Square. Afterwards, when buildings were constructed, this market was established and it moved from that location to this location. But basically, it was established in 1942.
The market shops and alleyways are piled high with goods ranging from decorative lanterns to rolls of ribbon.
In the beginning, the market was a meeting point for everyone because they could find everything they wanted: needles, thread, gifts and toys, and many other things. So it was a meeting place. Those who came from outside Amman used to ask their relatives to take them to Bukharia market. The Bukharia market was the main thing in Amman, a meeting place for everyone, where they found everything.
Although there are a number of modern centers in Amman, shoppers say they prefer the souk because it stocks specialty items.
Souk Bukharia has a heritage and a reputation, and we've always known that it has items that you cannot find in other malls. It is an enjoyable place to shop.
Whilst the souk faces stiff competition from Amman's upscale malls, it still manages to attract both regulars and visitors keen for a taste of traditional and exotic. Nolmakugu, CCTV.
Right then, currencies here for you. The Naira down by over 1 percentage point. The Rand also weakening off the fairly dismal news coming out from Eskom with regard to problems in power supply for the foreseeable future. Nothing as exciting, I'm afraid, as what's coming out of Switzerland. Bond yields all the way out to 9 years. They've gone into negative. Fascinating stuff coming all the way out of Europe. Now, here's what we're working on for tomorrow's program. Challenges to the Naira. That's our main theme tomorrow. We'll be looking at the fall in the oil price and uncertainties around the election in the next 4 weeks or so. How will these affect Nigeria's bourse and its target to achieve $1 trillion market valuation? We'll have the pros and cons of that a little later. And our week-long series on the effects of falling oil prices concludes in Kenya. All of that and more will be coming your way in tomorrow's program. But that's it for this edition of Global Business Today. Thank you so much for watching. The news continues online and offline right here on CCTV.